A very good morning. Welcome to Daybreak Australia. I'm Haidi Stroud-Watts in Sydney.
I'm Annabelle Droulers in Hong Kong. We're counting down to Asia's major market opens.
Good evening from Bloomberg's world headquarters in New York. I'm Shery Ahn. The top stories this hour. U.S. stocks slip and Treasury yields rise as signs of economic resilience accelerate an unwinding of dovish rate bets.
That message being reinforced in Davos, where Standchart's Bill Winters tells us the market's getting ahead of itself, and Christine Lagarde warns of continuing uncertainty.
Plus, Apple ordered to again stop selling its latest smartwatches over a patent fight, while Samsung teases its own expanded health tech push. This was a close on Wall Street, and we had that pressure on Apple for a second consecutive day, given, of course, the legal challenges that it's facing in its patent dispute against Massimo. We also had the broader S&P 500 and NASDAQ 100 as well down. Of course, the speculation that the Fed will be in no rush to cut interest rates, continuing to pressure the market. So we had the VIX hitting the highest level since November. That will be really at one point topping its 200-day moving average. Treasuries also fell across the board. The two-year yield topping that 4.3%. The dollar rising again as yields continue to rise, with the Bloomberg dollar index also topping its 200-day moving average. And you can see crude was slightly higher, but it was really a choppy session. Of course, you have the pressure from a stronger U.S. dollar. You have also the pressure from production outages here in the U.S. because of the cold front. But at the same time, tensions in the Middle East continue to push oil prices higher. But it was really to do with where the Fed goes from here, right, Heidi? I mean, it's all about expectations of the Fed's rate path. We know that a rate cut is coming, but when is a key question. And now traders pricing in about a 50% possibility that the first rate cut will come in March, and that's down from 80% just last Friday. Why? Solid economic data. Retail sales, again, really topping estimates and rising by the most in 3 months. Not to mention that coupled with that, we also had the Fed Beige Book as well, talking about strong consumer spending helping propel the economy and really offsetting that weakness that we've seen in other sectors like manufacturing.
And what's really interesting, of course, is we see these market expectations shift and ebb and flow on a dime, right? Or at least on any sort of comment coming from a Fed speaker. We saw that sort of, wall of worry being created by Governor Waller as well. But obviously, this is one of the key, if not the top topic of discussion going on at Davos at the moment in terms of, how these central banks will navigate this last final stretch of the inflation fight. And, adding to, I guess, what has been really a chorus of caution on not expecting too much when it comes to the next part of the easing cycle. Take a listen to what State Street had to say.
I think that the Federal Reserve, if anything, is going to err on the side of holding interest rates. If you look at labor markets, if you look at the underlying economy itself, it's quite strong. And I think that the danger of undershooting is far greater than the danger of overshooting. In other words, I don't think the Fed would like to see a resurgence of inflation.
And really the caution that we're hearing now from the private sector, right, from Wall Street, from the big financial heavyweights, really echoing the caution that's come from central bankers as well. And taking a look at just some of the commentary that we've had throughout the course of these conversations taking place at Davos, right? We heard from State Street just now, Bill Winters saying that the market might be getting a little ahead of itself in terms of rate cuts this year. He thinks that they'll get to rate cuts at some point this year, but perhaps a little bit later in the year. So maybe we need to, assess those expectations. Daniel Pinto saying the market pricing was until yesterday 6 cuts. He says that's a very unlikely scenario. So we continue to see this as kind of, the major driver as to how markets are going to, I guess, recalibrate expectations.
Which is really funny, right? Because going into 2024, we're thinking perhaps we could have a different narrative, but it's really the case that it's no surprises, again, the rate narrative. And it's not just about the Fed, right? I mean, we had the Treasury sell-off today with the two-year yield surpassing that 4.3%, the 10-year yield surpassing 4.1%, as well as that repricing took place, as you talked about. But at the same time, we had other central banks and expectations of where they are going that also sent that global bond sell-off rampant towards in today's session. So we had, for example, UK bonds falling, data showing that inflation picked up, so traders were paring back their bets on Bank of England easing, but also the ECB President Christine Lagarde at Davos, really fueling that speculation, saying that market bets on the big easing of policy are a distraction. So we continue to see this really more cautious tone when it comes to the outlook for monetary policy easing. So we are seeing those swap market data now showing that cuts to when it comes to the Federal Reserve interest rate, we could see about 140 basis points in 2024. And Heidi, that's of course down from a recent peak of near 175 basis points. But Belle, we of course have seen this really play out across markets here in the US. How are we setting up in Asia?
Yeah, well, the session in Asia today very much looking to track those moves that we had on the Wall Street day overnight. A fair bit of weakness that we're seeing across most futures on the screen here. Kiwi stocks you can already see here, likewise trading in the red. It's that theme of Treasury yields, that firmer dollar that came through as well. We've got the Japanese yen fairly steady right now, but it was weaker for yet another session, and we saw it declining as much as 1% at some points, but trading around the 148 mark, so fairly weak there. Something that could, of course, continue to boost Japanese stocks. We have seen them really continuing to be the outperformers in Asia so far this year. Other markets, though, trending a lot lower, and Korea is one of them, but China is, of course, really standing out to us. And yesterday it was all about that capitulation, really, that we started to see in Hong Kong and mainland equities. What's interesting, though, is when you do see that sort of level of stock weakness, we start to also perhaps monitor for signals of state buying. Let's bring up the terminal chart and look at some of the turnover that we saw in a major ETF in China on Wednesday. That ETF record for the E-Fund CSI 300 hitting an absolute peak record. And a lot of investors in the market are telling us this is likely perhaps, Heidi, a signal of the national team stepping in, really just trying to prop up the markets to some degree, given we had more economic data pointing to continued weakness in the economy there.
Yeah, Belle, look, national team or not, I think we'll take any kind of circuit breaker at this point when it comes to the negativity in that feedback loop for China, right? But let's get in some more market insights with our next guest. She says that rate cuts will present a tailwind when they do come, but markets will still be messy and volatile. With us now is Shery Ahn, CIO at Zuma Wealth. And, you know, Terry, the carry through from the end of last year and going into all of the conversations, be it you talk about Fed speakers or the big Wall Street banks, is really down to the timing of what the Fed does. Do you subscribe to the sort of side of things that the market has gotten ahead of itself?
Well, I'm not necessarily sure the market's gotten ahead of itself. I mean, I think you are referring to this question about, you know, how many interest rate cuts should we expect in 2024 now that everyone is expecting interest rates, including us, cuts in 2024. Earnings used to drive stocks. Now it seems like interest rates primarily do that. But, you know, as you referenced, we do think it's just going to be a messy kind of year because we don't know exactly how many cuts. We don't know when. Earnings will be erratic. It's an election year. There's a lot of, I think, you know, discomfort on both sides of the aisle as to, you know, what that's going to look like. So we're just going to have a messy year, and that can actually provide some opportunities. So regardless of how many cuts there are this year or when those come, we do think that there's going to be opportunity because it's going to be a messy market. In other words, expect volatility throughout 2024 and take advantage of the opportunities that brings.
Yeah, so how, I guess, flexible do you have to be in your positioning to try and take those opportunities if they do come alongside volatility?
Right. Yeah. I mean, yeah, that can be a challenge. But what we're looking for right now in the very short term is, you know, the S&P 500, we're watching that 46.88 level. We're pretty close to that, actually. And if we do get to that, I do think that there can be some potential buying opportunity. But that's, you know, it's not just one number that we're going to look at and hit the buy button. We want to see breadth in the markets. We are starting to see that. We don't just want to see 6 or 7 stocks driving the U.S. stock market. We don't even just want to see technology driving the U.S. stock market. We want to see some breadth in terms of other asset classes, other sectors. In particular, we're looking at the industrials, we're looking at consumer discretionary, and that broadening out in markets, I think, are areas where investors want to make sure that they have some dry powder in order to take advantage of opportunities as they present themselves over the next couple weeks and months.
Terry, how does the dollar factor into your portfolio? Because we were expecting for the longest time that we might see some weakening with the Fed expected to cut rates. We're going in the completely opposite direction with the Bloomberg Dollar Index now topping its 200-day moving average, not only because of Fed expectations, but just because of uncertainty and safe haven demand as well.
Yeah, I think you're bringing up a really good point with the dollar, because the textbook explanation is that as you see interest rates fall, here in the U.S., you should see a weakening of the dollar. Why? Because it makes our interest rates less attractive relative to interest rates abroad. So if interest rates are expected to fall this year, we would expect a weaker dollar. And as you pointed out, we're not seeing that. I don't know if that's because our economic growth is still toppier than other countries. The weaker dollar, if it does weaken, that would mean fundamentally take a look at international stocks, take a look at emerging market stocks. But the technicals on those are just not flashing anything that represents a buy signal for us. So those two things, a weaker dollar and a stronger technical picture would point us to international stocks. But as you pointed out, the dollar seems to keep getting stronger. And so we're staying away from those asset classes at this point.
I know emerging market stocks now losing more than 6% already this year, and it's just January. So Terry, what sort of buying signals are you talking about right now? And where in emerging markets would you look, given that it's such a diverse universe?
Yeah, I mean, frankly, we're not exposed to emerging markets right now for exactly what you pointed out. Technically, it's just not working out. And that's something we look at fundamentals, and we also look at technicals, because we can be right on the fundamentals all day long, but if the technical picture isn't agreeing with us, we're not going to make money. So we're on the sidelines for that. But I don't want to take that off the table, because exactly what we're talking about, if interest rates do fall this year, and the economy slows down in the U.S., which we haven't touched on much, but I do think that will occur. I do think we'll see higher unemployment rates here in the U.S., slow down in economic growth. That should work into a weaker dollar, which would put emerging markets and international stocks on the radar screen. But right now, we're just too cautious. It's been too strong of a downtrend, frankly, to the downside, and we don't want to put money to work yet in there.
Yeah, and it's been pretty choppy, right? I mean, we had very strong couple of months at the end of 2023. But Terry Spath, good to have you with us, CIO at Zuma Wealth, with her calls on the markets ahead. And still to come, the Biden administration will put the Houthi militant group back on a global terrorism list in a bid to stem attacks on ships in the Red Sea. But first, Samsung turns to AI to power double-digit growth for its latest flagship smartphone series. The details next. This is Bloomberg.
AI is going to be important. We believe, we're excited about it.
Search as we know of it is going to change, and the web as we know of it is going to change. And so we have a real opportunity.
We're addressing some of the most profound social challenges with AI in ways that are transformative.
I've got a little bit more capability than I had before because I'm being augmented through AI.
AI is going to change the nature of jobs.
If you're lucky, artificial intelligence will enhance your productivity.
It will create new jobs, not take away.
If you're unlucky, your job is gone.
AGI will get developed in the reasonably close-ish future, and it'll change the world much less than we all think. It'll change jobs much less than we all think.
At the end of the day, it needs to have guardrails. If we don't do those things well, like many things, it's going to be a problem.
Some of our guests in Davos with their views on the rise of artificial intelligence. Samsung is turning to AI features as well as it targets double-digit growth for its latest flagship smartphone series. Bloomberg's technology reporter Mark Gurman joins us now. Mark, so what companies are turning to AI right now? How is Samsung trying to use the technology?
Well, here's what I'll tell you. Samsung, typically you see new hardware features, upgraded cameras. These days, they're all in on AI, right? everything about these new phones is centric around AI. There's a new feature where you can use a stylus to circle an image and it can tell you exactly what is on screen and relay more information. There's live translation, so I can be on a call with another person around the world. As I speak in my language, they hear me in their language and vice versa. All done on the phone, all done on the fly using Google Gemini models. Here's a really cool one. If I'm in a meeting or I'm a student and I'm recording a lecture, I can just, snooze out and record the lecture on my phone. And at the end of the lecture, my phone will spit out for me a summary of everything the teacher said or everything that was said in the meeting. If you don't want to read a full article, which I don't encourage anyone to do, you can press a button and it can AI-ify it and give you a summary of what the article said. So we're talking about AI being weaved into every logical part of the system with these new Samsung phones and them bringing some of these AI features to some of their older devices. So I would say today is not only a big day for Samsung, but it's a big day for AI because we're seeing practical applications of this technology now, thanks to this new partnership with Google and Samsung.
We're also talking about the Galaxy Ring. We haven't really spoken a lot about, rings versus smart watches, right? Is this kind of the new area to watch out for?
Rings are extraordinarily nascent in terms of health tracking. Right now, the market leader in smart rings is a company called Aura, right? They're a small startup. They're not a public company. And I spoke to their CEO earlier. He told me, as they say, and this is an Apple line, imitation is the sincerest form of flattery, right? And at this point, we don't have much detail on this Galaxy Ring yet. They gave actually no detail. They didn't talk about pricing. They didn't talk about availability. And they didn't talk about any features besides integration with the existing product portfolio, as well as the slew of health sensors. I personally think that smartwatches are here to stay, but for some people, rings are the better buy. They're often cheaper, they're less capable, but you can get a lot of good data from a finger. And so I think rings at some point could be a big deal. Two other things I'll say on rings. Apple has some patents for smart rings. I don't anticipate them going, full throttle on a ring anytime soon, unless the Samsung one is particularly popular. And then Amazon actually released a ring about 5 years ago. It did not have any health features. They used it for voice, but they ended up discontinuing it in 2020.
Mark, before we let you go, Apple suffering another legal setback when it comes to its patent dispute with Massimo?
This is a huge deal. This is more than a setback. This is the Apple Watch yet again being banned. Starting tomorrow at 2 a.m. Pacific time, 5 a.m. Eastern time, Apple has been instructed they need to cease sales of the Apple Watch Ultra 2 and the Apple Watch Series 9. We're still waiting to hear Apple's response on this. I don't know for sure, but my anticipation is Apple's not going to stop selling the watches as they're being ordered to. Instead, they're going to take their plan. They're going to take another plan here, their plan B, and they're going to tweak the watches to remove the blood oxygen feature at the heart of the patent lawsuit. So that's my expectation. Check back in with me later today, and we'll probably know for sure.
Bloomberg's technology reporter Mark Gurman there on the story. Well, Qualcomm says business has been stable so far despite the tense tech rivalry between the US and China. CEO Cristiano Amon told us how the firm has been navigating that relationship between Washington and Beijing.
Our business actually with China actually increased as we diversify, our company not only into phones but into PCs and cars and industrial. We expanded our relationships with China. Here's my simple answer, I think, to that question. Any company that has a leading technology product and is a product that becomes very important for the digital transformation of many industries, such as automotive and others, you're going to have a big business in China. It's just a function of GDP. I think we have been so far in a stable place. We have to monitor the situation like every other company. And, I will continue to believe, and that's what I had said, at the end of the day, strong commercial relationships between American enterprises and our Chinese counterparts will be one of the things that could bring stability to the relationship.
Does that monitoring get more challenging if we were to see a former President Trump win back the White House next year?
Look, we're just focused on our technology, and we want to have markets that we can sell our technology. I think at the end of the day, one important thing to understand is certain technologies are globally interconnected. So you're going to have customers in different locations. You have customers in Europe and Japan. They will have a business in China as well, and you want to be a global supplier to them.
I can see the Qualcomm team just around the corner, very happy with that response, that you didn't take the bait and talk about the former president. Cristiano, I want to talk about the direction of travel in the global economy. For a chip maker, just for the industry, do you think we're close to the point where they have to pick a country, have to choose a side? We're either going to supply China or we're supplying Europe and America. How close are we to that moment?
Look, I don't think we are right now at this point in the industries that we serve. And it's one of those things that, yeah, if it changes, I think companies have to adapt. We have seen that some industries had to face that. You have some industries that's kind of the reality for different reasons, whether it's a cloud company or a social media company, and etc. We have been not at this pace, so it's something that we're going to have to worry about it in the future.
What industry do you think is going to be the biggest area of growth for you?
We are very pleased what's happening with automotive. We're now working with virtually every car company. The car is becoming a new computing space, and our job is to provide the digital part, and I think sometimes they go alongside electrification. That's exciting. It's going to build revenue for Qualcomm over time. The other one that was really happy about it, and it's new to us, we're entering the PC space. We just built now the fastest processor for any laptop, and we think that could be a great opportunity for us.
Qualcomm CEO Cristiano Ahn speaking with Bloomberg in Davos. And you can get a roundup of all of the stories that you need to know to get your day going in today's edition of Daybreak. Terminal subscribers go to DayBgo. This is Bloomberg. You're watching Daybreak Australia. Here are some of the corporate stories that we're tracking. JP Morgan President Daniel Pinto says the lender is likely to raise its headcount this year. Speaking in Davos, Pinto told us the bank has the ability to continue investing in its core businesses. He says JP Morgan sees opportunities in both retail and investment banking.
At the end of this year, around 320,000 people. So the number of people that we employ has been growing and not shrinking. So I think that where we see opportunities and we can help our clients, for sure, we will focus on that. When I look at our plans, we will increase our staff this year, for sure.
Bayer has laid out plans for sweeping changes, including significant job cuts in its managerial ranks, as new CEO Bill Anderson seeks to revive the crisis-rattled company. Workers supported the establishment of a new operating model that will mean slashing many managerial employees. The job cuts will begin in the coming months and end in 2025. This is Bloomberg. You're watching Daybreak Australia. OPEC is out with its first detailed outlook for 2025, and it expects global oil demand to increase strongly next year and exceed growth in supplies. Bloomberg's Sue Keenan joins us now with the latest. And Sue, China could be a big contributor when it comes to that demand outlook.
Yeah, definitely OPEC looking to China, which is traditionally one of the biggest consumers of oil, to drive this robust surge they see for 2025 in global consumption. They believe China, together with a recovery from the global economy, will result in an increase by 1.8 million barrels a day. Again, this is for next year. It sees rival supplies, and that's a reference to production from the U.S. and non-OPEC members, as expanding by 1.3 million barrels a day next year. And whether this bullish outlook will be borne out remains unclear, but it means that oil markets are set to remain in deficit through the end of 2025. And that is unless Saudi Arabia and its allies, which launched new production curbs this month, decide to boost output significantly. Now, OPEC issued the forecast in its monthly markets report a bit earlier than normal, and also on the very same day that its top official published a rebuttal to predictions that oil demand is heading toward a peak. This was an effort by the OPEC Secretary General to push back against expectations that climate change is going to cap the use of fossil fuels. As for this year, 2024, OPEC expects global oil demand to increase by 2.25 million barrels a day to a record 104.36 million a day, and that's unchanged from the forecast in last month's report. OPEC Plus, that's the 22-nation coalition, set to hold an online monitoring meeting on February 1st. Heidi?
New York traded futures, so that was quite a bumpy ride that we saw in the latest session. What are we hearing about sentiment?
Well, analysts are saying that despite the broader risk-off sentiment, we also have the stronger dollar, which is generally bearish for oil. We did see rocky trading in New York for West Texas Intermediate, but ending higher. For Brent, we saw futures end a bit lower. What's going on here? Well, WTI's prompt spread, which is a critical gauge for supply and demand, settled in a bullish structure known as backwardization. We haven't seen that since November. Of course, you have geopolitical risks. They're playing an elevated role, particularly with ongoing developments in the Red Sea, and concerns linger that the Israel-Hamas war could spread beyond Gaza. Layer on the fact we've got frigid weather here in the U.S., and it's not just cold here in New York with the dusting of snow, but on the West Coast and in the Northwest, you've got states such as Texas and North Dakota, where we're seeing an interruption in the state's refineries and oil processing. More than half of North Dakota's oil production is now offline. We're talking as much as 700,000 barrels a day. A top energy trader at CIBC Private Market says whether the latest geopolitical issues may incite short covering is one thing, but she thinks it only provides a short-term buffer to oil, which is otherwise in a weak fundamental environment, which means she believes, and many others do, the general direction of oil is lower.
All right, Bloomberg Sue Keenan there with the latest on oil pricing. And of course, we continue to see the tensions escalate in the Middle East. Yemen's Houthi rebels say they attacked an American vessel in the Gulf of Aden hours after the U.S. designated Houthis as a global terrorist group. Bloomberg's Vonnie Quinn joins us now for more on this. Vonnie, how significant is it that the U.S. has put Houthi rebels back on the terrorist list?
Pretty significant. In the early days of the Biden administration, they had taken the Houthis off this list in order to help the civilian population of Yemen. It was a very dire situation. This reverses that partially. So the Biden administration has chosen to now nominate the Houthis as especially designated global terrorist organization. So they're not putting them on the foreign terrorist organization list, which would be more serious, but they are, as you say, partially reversing that decision. In the State Department's statement, Antony Blinken said that there will be a 30-day implementation delay. So this is going to take place from February 16th. And during that time, the U.S. government will conduct robust outreach to stakeholders, aid providers, and partners who are crucial to facilitating humanitarian assistance. And also, the Department of Treasury is publishing licenses authorizing certain transactions related to things like the provision of food, medicine, and fuel in order to make sure that the Yemeni people have what they need and that the Houthis don't stop this from becoming a much more larger humanitarian crisis. The Houthi response, as you might imagine, was quite chest-bearing. The first response was grateful. The Houthis spokesperson said the designation was a badge of honor and a recognition of the impact of the group's ship attacks and support for Palestinians. And as if to reinforce that, hours later, we get this attack on an American vessel. So it was almost as if the Houthis were saying, bring it on, thank you very much. The spokesperson said post this attack on the vessel, which the ship owner did confirm, that there would be more attacks and that the Houthis were well within their reason to use attacks as self-defense measures. Now, separately and originally reported by Politico, I want to point out that the European European Union is very, very close now to signing off on sanctions for its part, targeting the Hamas leadership. This is slightly separate from the Houthi question and the group's financing. I mean, all of these are designed to sort of cut off funding for these various organizations. Well, the European Union hadn't come together on designating Hamas as a sanctions recipient, but it's now very close to doing that and will happen on Monday. And one of the sticking blocks was that some in the European Union said that travel bans should be considered and asset freezes for some of the Israeli settlers as well. So this is all getting ironed out according to people familiar with the matter, and we may hear more by Monday.
President Herzog of Israel headed to Davos, and in fact due to give a speech on Wednesday. He's accompanied by the families of Hamas hostages to try and step up pressure for the release. We know that about 136 hostages remain still captured, but also how are things going when it comes to the humanitarian aspect of this conflict?
Well, there's movement, at least, Heidi. How much, it's in the eye of the beholder, right? So, as you said, President Herzog and his wife and some of the families of the hostages are now in Davos. Today they were due to give a speech and to talk as well on panels on anti-Semitism and just ramping up the pressure really on international governments to get more involved potentially in turning the screw on the hostage situation, although that very likely depends on people like Benjamin Netanyahu. So as you said, 136 hostages. There was a Qatar-France moderated deal, as we know, to get some medicine to those hostages that desperately needed 3 months worth of medicine going into Gaza for those hostages. But the deal was struck with Hamas, and one of the sort of things that Hamas wanted was that for every box that went in for hostages, 1,000 boxes went in for its civilians. So that's happening right now. We have confirmation of that. And, there are still something like 15 hospitals, at least partially functioning in Gaza. The health system, though, as we know, is really cracking. The UN warning of famine, and the World Hunger Programme estimating that 93% of the Gazan population faces crisis levels of hunger.
Responding, Queen, there with the latest on the Middle East. And Bank of Israel Governor Amir Yaron now saying that the central bank plans to take a cautious, moderate approach to easing after a rate cut earlier this month. Yaron told his policy is still restrictive, and a negative demand shock from the Hamas war also slowed inflation faster than expected. Yaron says a new cabinet-approved budget will help stabilize debt despite the heavy cost of the war.
The war is costing us directly, and this is give or take about 10% of GDP and another 2% in sort of lost revenue. I call that the temporary hump of the war.
Well, the CEO of Standard Chartered says the market is getting a little bit ahead of itself when it comes to expectations of rate cuts this year. We spoke to Bill Winters at the World Economic Forum in Davos, where he told us the global economy is holding up well despite the ongoing wars in the Middle East and Ukraine.
I must say, 2024 is starting off from a banking perspective quite well. We know all the problems in the world, and we are always concerned how those are going to affect the operating results of our bank or others or our customers. So far, so good. I think the economy is in a reasonably good place. Of course, the tensions that are carrying over from last year are still there. Obviously, the war in the Middle East is a big preoccupation, and concerns that will spread, although it seems manageable so far from an economic perspective, yes. Obviously, perhaps not from a humanitarian perspective. And likewise, conflict in Europe, and likewise, the geopolitical tension. So, but these are, I won't say we're used to these things, but they've been around for a while. It would appear that no one has an interest in taking very substantial specific conflicts and turning them into major global operations. And I hope I'm not wrong on that.
The market is definitely pricing in a lot of cuts.
Yeah.
From the Fed, I don't know what that means for your trading floor. Are they ready? We could see a lot of volatility.
We could, although markets have been quite well behaved. I think the Fed has done a good job of forecasting and indicating for guidance their intentions. I think the market might be a little bit ahead of itself in terms of rate cuts this year. I have no doubt that we'll get to rate cuts at some point. I suspect it'll be a little bit later in the year, so we have this debate within Standard Chartered all the time. And we're positioned in terms of our from a treasury perspective, we're partially hedged, but we're okay.
Standard Chartered CEO Bill Winters there with Bloomberg's Francine Lacroix in Davos. And coming up next, we continue to hear from high-profile guests. European Central Bank President Christine Lagarde is talking to Francine as well at Davos. Hear her views on the timings of any rate cuts this year as inflation concerns linger. This is Bloomberg.
Take a look at how currencies are trading in the early part of the Thursday session here in Asia. We did see the dollar strength, a rally really extending into that fourth day, along with the rise in yields. We are seeing the Aussie dollar actually holding on to a little bit more momentum at 65.54, perhaps a little bit surprisingly, given further downside expectations of the Chinese economy, given the disappointment in the domestic activity data yesterday, and some of the downside that we've seen in the pullback in iron ore as well. But really, that picture of dollar strength, the Bloomberg dollar index climbing about 0.2%, topping that 200-day moving average, and it was really performing stronger against all of its G10 peers, except for the pound. We are seeing that Aussie showing a little bit more resilience than previously. The Kiwi dollar is largely unchanged. We're watching dollar yen at that 148 level as some of that repricing when it comes to not just the Fed, but also potentially how that plays into expectations of the BOJ as well. There are sort of further reasons from analysts suggesting that the BOJ won't be thinking about ending yield curve control until the end of April. So continuing to watch that very closely. Well, the European Central Bank President Christine Lagarde says a rate cut could come later this year. Speaking at Bloomberg House in Davos, Lagarde says more evidence, though, is needed before policymakers can be sure that inflation in the Eurozone is under control.
I'm confident that short of another major shock, we have reached a peak. Okay? Now, we have to stay restrictive for as long as necessary to make sure that we get to that state where we are all saying, okay, confident that it is at 2% medium term. I know some people argue that maybe we are overshooting, maybe we're taking risks. I think the risk would be worse if we went too fast and had to come back to more tightening, because we would have wasted all the efforts that everybody has put in the last 15 months.
But this would be, again, economically or also the trust in central banks? If you get this wrong, does it hurt the credibility?
Credibility matters, let's face it. When we say we will get to 2% medium term and this will happen in the medium term as we define it, if people believe in that, and they should, because we will do it, it matters. It is a component in the sort of chemistry that determines inflation going forward.
And again, so the timing is quite fluid, but there seems to be a majority on the Governing Council that expected probably by the summer, if not in the summer.
You know, and you've talked to some of them, they have spoken recently, and each of them has their view, which I respect completely. We generally coalesce towards the decisions that we make on the basis of data. Some of them have their local domestic data. They have their respective inflation rates, which are different from one country to the other in the euro area. Where, if you look at Portugal, if you look at Germany, it's going to be different, obviously. But it's their job to say, well, it's likely that. I would say it's likely too, but I have to be reserved because we are also saying that we are data dependent and that there is still a level of uncertainty and some indicators that are not anchored at the level where we would like to see them.
The US election.
Yeah, let me have some coffee.
How worried are you about the US election?
It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. But this is what they should be considering. And of course, we cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation.
ECB President Christine Lagarde speaking with Francine Lacroix at Bloomberg House in Davos. Let's stay with Davos because we want to get more insights from the World Economic Forum. Annabelle joins us for Morning Calls Bell. So we've also heard from the head of the Hong Kong Stock Exchange. What did he say?
Yeah, well, I think firstly we can just say what a day for us to be hearing from Nicholas Aguzin as well, because Hong Kong stocks were down as much as 4% yesterday in the session. A really bad start to the year for equities here. And Nicholas Aguzin there in Davos being asked about the performance so far. He said that we are no doubt closer to a capitulation point. Of course, we've as well really heard that before. You seem to think that we found a bottom for Chinese equities. They tend to go a leg lower here. But he says one of the big growth points or points of opportunities, a bright spot, is that relationship. And we are continuing to see those ties grow between China and the Middle East. He was also asked about the potential of attracting Aramco for a secondary listing here in the city. He didn't comment on that, but he did explain why he thinks we're seeing so much selling pressure from Hong Kong equities. Take a listen.
There is, maybe a lack of convictions in the markets at this point. We've seen the 10-year that once again it's just like over 4%. So when you start combining higher interest rate, a lot of geopolitical flashpoints around the world, I mean, some concerns that maybe the growth rate in China was slightly below what people were expecting to be. All those things, I mean, get together and create an environment where investors are selling.
Belle, despite the economic weakness, the structural issues, we have still heard some optimism from business leaders on China.
Yeah, that's right. And one of those was the global CEO of MasterCard, Michael Maybach, and he was speaking to us again from Davos. He is someone who, of course, has a very good finger on the pulse of consumer spending patterns on an international level. He said that 2023 was really a year when we saw consumer spending resilient. He says 2024 is about trying to expand globally. Here's where he's seeing opportunities in the Chinese market. Take a listen.
Small business in China, as in many economies around the world, small business isn't served as well as other corporate sectors, so that's a big opportunity. You always have new people entering into the payment market, into the digital economy. That is a continuous, as the population grows, that is a continuous opportunity for us. So all across we see plenty of opportunity, and that cross-border angle is still very unique.
Watch us live and see our past interviews on our interactive TV function, TV Go. You can also dive into any of the securities or the Bloomberg functions that we talk about. You can join in on the conversation as well. Send us instant messages during our shows. This is for terminal subscribers only. Do check it out. It's at TV Go. This is Bloomberg.
Welcome back. India's Mahindra Group says it's targeting a five-fold increase in revenue from its resorts business. We spoke with the CEO, Anish Shah, in Davos, who told us the conglomerate is looking to capitalize on strong international investments.
Across the Indian industry, we've got a very good set of businesses, and we've got great partners in terms of marquee investors who've come in over the last. We got British International and Temasek into our EV business. IFC and the India-Japan Fund by NIIF have come into electric three-wheeler business. Ontario Teachers has come into our sustain or renewables business. So we've got a great set of global investors who've come in, and they want to do a lot more with us across multiple businesses.
Will that growth translate to more hiring for the year and the next?
Yes, that will translate to more hiring, more revenue, more profits, all of that.
Could you quantify that?
At this point, I would say each business will have a different model. So in holidays, for example, we are looking at growing 5x. So we have 100 resorts right now. We got 5,000 keys in India. In terms of keys, we want to grow to 15,000 keys, and then translate that from a revenue standpoint will be a 5x jump. In terms of our life spaces or real estate business, we're looking at getting sales up between 5 and 8x over the next few years. So each business will have a different set based on its growth projections. So I'd say tougher to give a number at an aggregate level, but on balance, I'd just say that we are in a rapid growth mode at this point.
The Davos crowd is currently obsessed with AI. Is it overhyped? And how do you see AI disrupting your businesses?
I'd say AI is overhyped for the short run, but it has a lot of potential in the longer run. This really comes back to practical applications, right? And as we've gone through various different cycles in technology, we've talked about Meta, we've talked about blockchain. I mean, there are a whole host of things that were, the next thing that's going to change the world. And today, AI is the next thing that's going to change the world. So we do feel that it will have a significant impact. But it really comes down to what are the use cases and how can we make that real from a productivity standpoint. And much of that work has to be done.
Was Mahindra CEO and MD Anish Shah there speaking with Haslinda Amin in Davos. Well, one stock to watch when trading opens here in Australia will be Qantas. The flag carrier may move after they named Andrew Glance as a new CEO of its lucrative loyalty business unit. We've also really coming off what was really a pretty horror year, so perhaps a little bit of upside for Qantas is overdue. There was a survey yesterday that showed a huge dive to number 41 when it comes to the brand value of the once dominant Qantas name. Of course, it was a year that included being litigated against for allegedly selling tickets on cancelled flights, really fueling the ire of travellers with its since shelved flight credits policy, amongst a number of other negative headlines there as well. Qantas's brand value as a result of this annual survey taking a nosedive. Potentially that creates more of a red flag for investors as well. But some clarity when it comes to who replaces the loyalty CEO, Olivia Wirth, who is set to depart in February. Take a look at how we're setting up when it comes to other Asian markets across the region. This is how the picture is for Sydney futures. Pretty soft at the moment, 0.8% lower there, with stocks and bonds really overnight faltering that much. Fed cut now in doubt.